So can you guarantee a return when it comes to stock investing? So I've talked to many people without investing background, and this is actually one of the questions I get a lot. Now, when you're looking to invest and make a return, I think the intuitive answer is no. And, a lot of people are unhappy with that answer. Now, obviously, if you learn options and you have a strong understanding of what you're doing, you can probably get very close to a guaranteed return. But the more you learn, the more you realize there's no guarantee in the world. So let's think about why that is the case. Now, when you are investing in the stock market, you need to take a step back and think about what are the possible investments you can invest. And there's something called a risk and reward curve when you're studying investing. It's actually quite straightforward. First, you have almost guaranteed investments. This is like money market funds. This is like guarantee investment certificates like GICs in Canada. There's another name in US, I forgot, but it's like 1% or 0.5% or term deposits. Basically, things that you know for sure you can't lose money. That's what other people are willing to pay you as a guaranteed return. Now, later on, I'm going to create a video to talk about salary and certainty as well, so you can look at that and automation. But you will start with bonds, and bonds give you 1%, 2% if you're lucky. So something a little bit less than inflation is what you're getting. Basically, you're lending money to someone else to make a higher return. That's how I see bonds. Now, if you move up the curve, then you might get something like real estate or a little bit riskier bonds, like corporate bonds, like Coca-Cola, like Apple bonds, Microsoft bonds, so on and so forth. So when you look at these bonds, there's a little bit more risk. Apple is obviously not as safe as the US government bond, which I guess we can argue about that, but it would offer you a higher interest rate. And if you look at riskier and riskier companies, the interest rate will be higher because even you as an investor, if you lend money to the US government versus you lend money to a medium tech company that is losing money, you would want a higher interest rate, right? It is only natural. So what is risk really mean in this case? When you're looking at the bond, let's say we take it to the extreme. This company doesn't really grow that much. This company is losing money. And this company wants to borrow money from you. So would you lend it to the money at 1%? Well, probably not. You understand that you might not get the money back. So you want the interest rate to be higher, like 7%, 8%, something like that. But the higher you demand the interest rate, you also understand there is a chance you might not get your money back. And that is the risk. Whether that is 10%, 20%, 30%, you might not get your money back. And that is the uncertainty. So if you take this bond concept, like lending money to somebody and not getting money back, and you bring it to the stock market, then you'll realize it is basically the same. So let me explain. When you're looking at the stock market, how do you make money? There are mainly two ways to make money. One of them is a dividend, which a lot of people think is a guarantee, but is actually not. And the second one is a stock price increase. Now let's tackle the dividend one first. Now, most of the time, if you choose dividend from a very safe company, they make a lot of profits, they're growing year after year, like Apple, then people will think that is pretty much guaranteed. But not all dividend is created equal. What if you get dividends from a mining company? So mining company are heavily impacted by commodity prices, and it is risky. I wouldn't say it's low risk. For example, copper price, iron price crash today, then these companies wouldn't be giving you a dividend. It's pretty straightforward, right? So even dividend has uncertainty. And uncertainty is what you need to deal with as an investor. So let's talk about the second one, capital gain. The stock price itself change. Let's say here you are today and you want to invest in a stock that is $100. Now, maybe there's something happening in the macro environment. Maybe you believe that this company will expand into China and they grow. You think it will be worth 110 1 year from now. Okay, so there is a stock price increase by 10%. Now, you don't know it for sure, but based on your research, you think the probability of that happening is very likely. So there is a possibility that the expansion in China will fail. There's a possibility that you're overpaying for it. There's a possibility that the CEO might be suddenly fired. What am I getting at? Is that the future is uncertain. And you as an investor, your job is to take on this risk, analyze the risk, and making sure that it is worthwhile. What does worthwhile really mean? It means that the odds of you being right is very high. So when it comes to investing, you have a lot of control over what is high probability. And a lot of people make the mistake of trying to invest in low probability outcomes, which is why they lose money. You want to invest in high probability outcomes, like something you're really, really, really sure will happen. If you know something will happen in the future, then you can invest in something that will benefit from it. So let me give you an example. And this is rather a straightforward, example. So COVID. Now, today is 2021, 1 week before Christmas, and we have the power of hindsight. But I think this is such a straightforward example that you will get it immediately the moment I tell you. There's a pandemic. What is needed? The answer is vaccines. So you would go find a vaccine stock. Now, during that time, Pfizer was one of the stocks. And I did my research. I know that Pfizer, Moderna, and some other companies like Johnson & Johnson are making a vaccine. And if you analyze these companies, you'll find that during a specific period of time, Pfizer was at a discount. So if you know that Pfizer is expected to make a lot of money from the vaccine because the entire world needs it, then you have a very strong case to invest in Pfizer. And that is what I call a view, a perspective, or investment thesis. However you like to call it, that is the reason on which you think you will make money. Now, is it certain that Pfizer will be the one that makes the most money? Is it certain that the stock price will increase by X amount if Pfizer's vaccine is successful? At the time in which I invest, you don't know that. But if you did your research, you develop a view for what will happen in the future. Because without that view or without knowing what will happen in the future, you can't make a profit from the stock market because it requires a change in price. And a change in price is caused by a change in the reality. So you need to develop an understanding of what you think will happen in the future so then you can profit from it. So that's really where research comes into place. That's why I focus so much attention and energy on research, because that's what you need in order to develop your perspective. Now, then you ask yourself, are you going to be 100% right when it comes to your perspective? And the answer is, well, obviously no. So then there's no way for you to guarantee any return from the stock market. And the answer is yes. There is no way to guarantee any return. Now, there are some smart techniques you can do or create certain risk to reward ratios or environments so then you can profit like 80-90% of the time. But it's important to understand that if you're looking to learn investing, you need to assess risk. You need to assess the probability of something happening in the future. And if you can assess that probability, then you can invest. If you cannot assess the probability, like you have no idea, you didn't do your research, and you just got a tip from Motley Fool or something, then perhaps you wouldn't be so confident when you're investing, and it only makes sense. So that's why, if you ever schedule a call with me after you watch some of the free materials I have on the internet or the free case study, there's no guarantee. So I think as an investor, when you're just starting out, everyone wants guarantee. And if you cannot guarantee, you're a scam. That's not how the stock market works. If you just look at some of the most intense algorithms, machine learning algorithms in the world, you might ask, can they predict what the next candle is? Candle is kind of like the next price movement in the next 5 minutes, 1 minute, or even 1 hour. If there is a machine that can predict 99% of the movement in even just the next 5 seconds, that will dominate and change the world. And the truth is, there are a lot of algorithms, and most of them, they either have a very low probability, like 40% or 30%, or some of the higher probability ones will become outdated over time, and you need to keep refreshing the algorithm. So it's kind of important to keep in mind that if a machine learning algorithm with millions of parameters are not able to predict more than 5 minutes into the future, then perhaps there's no certainty when it comes to the market. Now, I have one more example for you. Let's say today is 1 week before Christmas, and you invest in some agriculture stock. Maybe it's corn, maybe it's wheat, doesn't really matter. And you think that during the summertime is going to be a great harvest. Okay, so then you buy a bunch of wheats ahead of time. Okay, now summer comes along and there's a giant hurricane that's just destroyed the entire middle US. Or there's climate change that was so hot that a lot of the crops died. And well, is there any way for you to know today that a hurricane was going to happen? Is there any way for you to know today that there was going to be a drought next year? And the answer is there isn't. So that's also something you need to keep in mind, is you can make a decision, do your best based on the information you have today, but then you can't prevent yourself from things that have not happened yet. And there's no way that you can know ahead of time that next year the hurricane season will be really bad. So what you need to do is to lower that amount of risk as much as possible, so then you know you're getting value out of it, like a value investor, so then you protect yourself. And that's how you deal with uncertainty. So you develop a view, you figure out, what is the stock you need to invest in to profit from it, and then you buy and hold until what you're looking for happens in the world. And if you're wrong, then of course you'll lose money. If you're wrong, there's no way you make money anyways. If you're right, then you will be profitable. That's why I spend so much energy, focus on research, because that's what it comes down to, is you need to develop that view.